This video is about how to incorporate price index adjustment in this stock market return model. That is, we just want to control for inflation. First of all, we need to have data on inflation for each year. For that purpose, basically, we need to collect this index called Consumer Price Index in the United States. You can go to, as we talk about in the book, there's one excellent source of economic data called Fred. Okay, so you can get downloaded data directly on their website. So this is just for look at the year over year. But what we really need is the two. For example, if we want to know how much price inflation has there been from 65 to 58, we would just divide this number 31.5 over 28.1. So let me just quickly do that. That would just be the inflation from that period. Now this usage is very important in our CPI factor calculation, because the next is exactly what we are going to do. So how do we calculate all the possible inflation scenarios? Well, following that same technique from the previous one in calculating unadjusted returns, we first of all set up the investment year as in the top row here, and withdraw year in column. And let me use this as an illustration. Similar thing. So first of all, check whether it is the same year. If it is same year, give a 1. And if it is you are withdrawing before making investment, this empty space here doesn't make any sense. Give a white space. But if not, we need to grab two things. First of all, look at year 65 and go to the CPI spreadsheet, which we just saw, and grab that second column. Well, the second column is exactly the relative price here, and divide that with the price index in the year of investment. So this is what it says. So zoom out a little bit, and there we have it, all the inflations being recorded. So again, what it means, so let's see, we pick here. So it means that if you invest in year 1957 and you withdraw in 1977, the price has more than doubled, 2.2. So this really put a dent on your stock market return. So that's exactly the next model is. If we go to adjust it, simply do the following adjustment. It grabs, well, if it is empty space, then we still put in empty space. Otherwise, we go to adjusted return and divide that with that CPI factor. That's how we adjust price inflation. Then we do a conditional formatting just to see kind of where the highs and the lows. The reds are pretty low return, and as you can see, if you invest a long enough horizon, in general you get good return overall. And this is a cumulative return, and to do a simple adjustment on the yearly basis, we do this. So if you look at average return, this is basically the average return divided by, as you can see in formula here, divided by the years of investment. So as you can see here, several insights does come into the picture. First of all, there are periods of time that the return are quite low, but if you hold long enough, meaning that if you say 20 years, 30 years down the road, you generally get a positive return, and there are good years, of course. So when you go into the market and when you withdraw, does matter. For example, a terrific year would be if you invest in year 1982 and then you say withdraw in 20 years later in 2002, and the average return would give a whopping 27%. That's just incredible. So, but sometimes we don't get to choose the timing. In general, though, you do get the return, but it may not be the 12% that we've been hearing about, and it would not be 0% either. So that's the general conclusion. For more details, it's in the text.